All right, guys, so what the heck do lenders look for on your credit report when you are applying for a mortgage and trying to buy a house? We will go over some of that and a few of the misconceptions that are out there. If you don't know me, George Morales coming at you. I am a licensed loan officer here in the state of California. Make sure to like and subscribe to this video if you found it useful. So what do lenders look for? So if you're applying for a home, let's say you're buying your first home or maybe not your first home, there's some misconceptions about this, but the first thing that we will go over is which credit score that they will actually look at. So you usually are going to have 3 scores from 3 different credit bureaus: Equifax, Experian, and TransUnion. The first thing that you need to know about this is that they are going to look at your middle credit score. So if you have a credit score, let's say one of them is 700, the other one is 712, and the other one is 725, the score that lenders are going to use to qualify you and to determine your pricing is going to be that 712 credit score, that middle score, not the lowest, not the highest. If you are applying with a second person on that application, they are going to take the lowest middle score out of you both. So if you have a 700, 712, and 715 score, they'll use 712. If you are playing with a partner and they have a 700, 707, and 720 score, they're going to use that 707 credit score because that 707 is lower than that 712 score. Now, there are some instances where they will average both of those credit scores to determine whether you qualify for certain programs. But in general, they're going to look at that middle credit score. That's the first thing to know. Now, this misunderstanding that I come across all the time when I'm talking to clients is that they believe that, lenders really look at what your balance is on these trade lines that you have on your credit report. So if you have a credit card that has a $10,000 balance, they start trying to tell me about what their balances are and how much they owe on them and how long they've had them, things along those lines. Really, what lenders are going to look at on the mortgage side is they're going to look at what's the payment on that account. So if you have a credit card with a $1,000 balance and the minimum payment each month is $25, all that mortgage lender really cares about when calculating your debt to income ratios is going to be that minimum $25 monthly payment on that credit card. If you have a car loan and you owe $50,000 on it and your payment is $500 a month, all they look at is that $500 a month obligation to be able to calculate your debt to income ratio. So keep that in mind. Now, one thing that comes up sometimes is student loans. If you have student loans, especially over the last couple of years, there have been a lot of deferments that have happened on student loans. So when it comes to student loans, they're a little bit different depending on the program. But if you have student debt that is deferred, chances are that it is not going to show a payment on your credit report. So if that's the case, lenders are going to usually take anywhere from 0.5% to 1% of that balance that is owed on those student loans to calculate your debt to income ratio. So if you owe $10,000 on that, they're going to take $100 as your monthly payment. If you're going on a conventional loan, they are going to use 0.5% of that if you are using an FHA loan. There are some instances where you can set up an income-based repayment, or if you have some kind of payment plan that shows a different payment than that, then you can use that as long as you can show the paperwork. But in general, if they are deferred and you're not making payments on them yet, maybe because you're still in school or because of the pandemic or whatever, then lenders are usually going to use either 0.5% or 1% on the FHA or conventional side, depending on the program. Next thing is installment loans. Car loans, this is pretty common with car loans. One thing to keep in mind, and a little bit of a good news, I guess, is that if you have a car payment, and let's say you have 10 payments or less that are left on that car payment, assuming that it's not a lease, it cannot be a lease actually, it has to be an installment loan. If that's the case and you have less than 10 payments left on that, lenders can exclude that debt from your debt to income ratio. So this is super helpful. And last thing, I will go over one question that I get all the time is how many points will my score drop if you pull my credit when applying for a mortgage, or I don't want to apply for a mortgage because I don't want a hard inquiry on my credit because it's going to tank my credit score, or is it true that I have a 45-day window or 14-day window or however many number of days window to be able to shop mortgage lenders, look at 2 or 3 different options and not impact my credit score? There's all kinds of different numbers that I've heard about, but I've never actually confirmed it myself. So when I speak to my clients, I let them know that it can make an impact on your credit score depending on how many times you have your credit pulled, how many points it's going to drop, who knows? If it drops, who knows? Your credit score is 800 or 805 and you get 1 or 2 credit inquiries and it drops your score to 785 or 780 or whatever that may be. In general, that's not really going to make an impact, a negative impact on your interest rate that you get for that mortgage. Usually 740 plus credit scores or above are going to be subject to the same interest rate. So it's not something to really worry about if your credit score is good. If you have a credit score that's on the lower side and you have concerns over it dropping below a certain score, then that's when you want to keep that in mind. Now, again, some lenders and some real estate agents and some just real estate professionals in general say that you have X amount of window, and I think there's even a government website on there that talks about how you have 45 days to be able to shop lenders, and it doesn't make an impact. But again, I've seen that actually negatively impact a client of mine, and scores go down when there are multiple credit inquiries. So I've not confirmed it myself firsthand, so I don't like to say that. But at the end of the day, if your score is in the higher 700s or even 800s, then it's not something that you really need to worry about. So hopefully this is helpful for you guys. If it was, make sure you hit the like button, make sure you hit the subscribe button, or share this with a friend.